Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure, my co-host,
Guy Allard.
Just playing that. That's an inside joke, folks. I'll tell y'all later. Well, I thank everybody for listening today. Remember, how long was this show developed? 20-something years ago?
Yeah.
It's been a long time, and, we do it differently than a lot of others. Almost every show that I hear is basically an infomercial about their next seminar or an annuity or a managed program, something like that.
Or some sort, the better ones, I guess, are consumer advocates, but they're trying to get syndicated.
Right.
And then they want you certainly to go to the classes, buy the material, buy the books, and all the things so that they can make sure that you don't make any missteps. And we try to do that here with out and charges.
And we try to expose scams out there whenever we can, whenever we see them. Anytime somebody tells you you're going to make 2 to 10% a month, it's a scam.
I was talking to a gal on the phone, a couple days ago, earlier this week. She inherited some money from her dad, and how it is when you first get some money, you start going through it. You buy the house, the grandkids, the kids need to pay for the wedding. They need a new car. They want schooling, and the whole 9 yards. So she's getting hit from everywhere. And she's down to a few $100,000 out of probably about 800, which she just got like 90 days ago. I mean, it's going really fast. We're trying to help her, but you can't take it all, right? You got to leave some for expenses, and you can't put it all towards income and all that. And she said, well, Guy, I was talking to a guy the other day, and, don't worry. He was telling me the house is paid for, right? Part of her money. He was telling me that I could get an equity loan on the house, use that for investments, and the income from those investments would not only pay for the loan, but give me a little extra money each month.
Moly.
You think we should get some information on that deal?
Yeah.
But those are the things, holy cow.
Oh, I hear all the time. Don't IRAs, 401ks, that's the government's money. Don't do that.
Yep.
If you can leave your company to get the 401k, do it because you need to do this investment.
Yep.
I'm like, oh my gosh.
Now, Victor and I both, I'll let a little cat out of the bag, have dear friends that have chased the dream their whole life. We're in our late 50s, mid to late 50s, and they are too. And it looks like, and if you hear them tell it, they're probably worth $1 billion or so based on 10,000 or so in Bitcoin. And Victor was talking to one of our friends the other day. He goes, oh, no. And he was dead serious. I'll be worth $1 billion. How long did he say?
Oh, just shortly.
Shortly. I'll be worth $1 billion. Now.
And who knows?
Who knows? Bitcoin right now, they're talking about it Thursday of this week on the Fox News channel or Business Channel. Now it's going to be registered. It's going to be trading. People have said it's done all this growth. While it's still very difficult for, people don't know where to buy it, how to sell it, or what to do. But now they're going to start regulating it. They were announcing Thursday and trading it. So I don't know. If you listen to Stuart Varney or a lot of the people that watch this stuff every day, they say run. Mark Cuban was quoted as saying, if you want to go broke, buy Bitcoin. So obviously there's two sides to everything, but I also remember Amazon back in 2000 when it was 600 and 700 times earnings, and that was scary too. What do you think?
There is absolutely no way to tell.
What do you think?
I have no idea. All I know is anything that's not regulated never ends that way, and it never ends well. But that's the allure of it, that it's not regulated.
And it's intoxicating, right? 400 to 9,000 in less than a year.
The U.S. Treasury, the IRS, is very good at getting our money.
Yeah.
And if it becomes an issue, trust me, they'll figure out a way to get it. And there's not much you can do about it. And if it does get regulated, it's going to drop it like a stone because that's the reason people want it, because it's not regulated.
That's right.
They said there's like 30% of it missing, not trading, that's been issued because people lost passwords to their internal electronic safe.
Gone forever.
Yeah.
My word from our experience and hopefully a little bit of wisdom I might try to impart on Bitcoin is this. The reason it's so intoxicating now and the reason now that you're hearing about it is because it's made this move within a year from $400 to $9,000-ish. It's fluctuating which is a big move, right? Every one of us wish we could have got in at 400 or 200 and get out today. Well, that move is gone. So for it to make that size of a move again, just think how high it has to go. So that train truly has left the station. We don't know if you'll be able to get out of it. It certainly doesn't seem liquid. You have to have a buyer for you to be able to sell. So don't get into it because you're feeling bad because you missed that big move.
One thing is the commodity exchanges are starting to, you can buy commodities on it.
Yes.
The only problem with commodities, you're just betting on the price. Now, that price went from, what, 9,000 to 12,000 in one day and back?
And back. That's right. Yesterday.
Yeah, in one day. And so it is, if you ever know anything about commodity, we were commodity brokers back in the 80s. And a price of a commodity is based on volatility and all that kind of stuff, or options and all.
Duration, how long you've got. Yeah.
So you imagine something moving 9 to 12,000 and back in a day, how much it would cost. And you're not actually owning the Bitcoin. You're just betting on the price of the Bitcoin. And that's the only regulated portion I've seen so far. So just be careful. I'm always one of those people that anything's too good to be true probably is. Well, who knows?
The other thing to think about, if you've got something, you think about currencies and if you're buying something in euros and the difference from our currency, think about something that someone has to set a price for something that's $9,000 a coin one day, or within that day, and then it goes to 11. How do you set a price to sell something?
And eventually you have to get it back to dollars if you're going to live here.
That's right.
Eventually. Because it's got to convert one way or the other, because nobody's going to take it for a house or something like that if you want to buy a piece of real estate. They might, but it's just going to be really difficult. But who knows?
The people receiving it, like Victor said earlier a few minutes ago, once it gets regulated, it stops the ability to move money out of China, let's say, which is very difficult, because you could take $50 million on your cell phone out of China in Bitcoin, where you couldn't, carry luggage, the racks full of cash to get it out. But when you buy something with it, whether it's, there's a few people right now, a few companies, I think Home Depot, Dell, the list is growing that will accept it. Somebody along the line is going to have to report it for taxes or
they're converting it to dollars.
Yeah. Yeah, and it's going to have a record. There's going to be a paper trail at some point. As long as it's cryptocurrency,
as soon as you buy something with it, there's a record.
Yeah, and at that point, if they step in and get a hold of it, the price will go down because it's regulated.
Yeah, somebody asked me, do you think? I go, I have no idea.
Yeah.
I couldn't have told you the dang thing was going from this to that or whatever. I have no idea. All I know is if it's not regulated, usually it ends up bad. But hell, this one might end up, completely different. Who knows? But it reminds me of our philosophy. Our philosophy is based on 60 years experience between the two of us, plus about every major. I've got 4 Nobel Prize winners.
Thank you.
All kinds of different professors of Ivy League schools that say.
I tell you not to mention that. But
believe in this philosophy. We believe your bill should be paid with a guaranteed income stream, whether that's a pension, whether that's Social Security, whether that's an annuity out of that, whatever it is. If it pays you every month, at least your hard expenses should be paid by something like that. Otherwise, you're going to have the sequence of returns risk if you're having to sell stocks while they're down to pay your bills. Then, after you have all the bills paid, the stock market is a great place to beat inflation long term. Nothing wrong with it at all. There's nothing wrong with all the other accounts you have. If you have some commodities, if you have a little Bitcoin, whatever, it's okay, but the bills have to be paid first. Too many plans that I see are relying on what the stock market will or won't make to pay their bills. I see this from the biggest companies in this business. I just saw one the other day again where they said, we did a retirement plan, Victor, and we don't believe in your assessment. I go, well, why not? And they said, well, we took this same person. They had $100,000 a year in expenses, has, a couple $1 million. And they said, we believe they'll be fine. I go, what are you basing that on? Look, we did this whole thing. It's like a 50-page report. Nice, beautiful charts all in it and everything else.
Monte Carlo simulations?
Oh, my God, Monte Carlo simulations. It's gorgeous. I'm like, wow. Somebody that doesn't know anything would think this is I'd be very impressed with.
Cat's meow.
You look in the fine print, and it says if you make 8 to 10% on your equities till you die. Now, think about that. They're wanting you to put this $2 million in equities at 10%, so you're making $200,000 a year.
And you only need 100.
You only need 100.
I like it.
I could have said, you didn't have to go through all these research and
Could've helped you with
processes
that.
with me or this other person. If you were going to make 10% a year till you die, you're fine. You don't need an analysis. You don't need anything. Put it all at Vanguard and just stay in the indexes. But the truth, what it's ignoring is this. The stock market's made 4.06% a year for the last 17 years with dividends.
And without paying any fees.
That's right. And you can't do it, not pay fees. What is it, like 10% of professional advisors equal the S&P? The average person made 2% during that entire time. So you're ignoring this entire century, and you're saying it's going to go back to this. And so that is a very dangerous thing to do. You cannot have a fluctuating pot of money paying bills because you'll have to sell when things are lower. Now, you can do that if you don't need $100,000. Let's say it drops in half, and you only need $50,000 now. Well, you can do that. If your bills are like that where, no, this is really my bills. But that's what I'm saying. Your hard expenses have to be a guaranteed income stream.
And we talked about with Bitcoin and how intoxicating it is going from 400 to 12,000. Don't let this current stock market get you intoxicated. And I mean, don't let it get you intoxicated. We just are coming into, as we conclude November now, and we're into December, the largest consecutive months of gains since 1995, and longest in 22 years of consecutive gains. And, the more that happens, it becomes the norm, and you get used to it, and you expect it. And being in the business 30 years each or 60 years total, I can assure you, one of the benefits of experienced advisors opposed to a new guy, we haven't just read it in the textbook. We've been through the ups and several downs, and it will happen. We just can't tell you when.
And remember, that was 4.06% was without this giant run-up in 2017.
Right.
So when you add that in there, I haven't done it mathematically, but I'm telling you it's going to be like 4.2. Because it's 1 year out of 18.
Yeah, there'll be a little bump.
It's 20% year, which is fantastic.
Right.
My stock accounts have done great.
Oh,
I love them, right? But it's going to be like 4.2. And there was another, you've heard all this gloomsday. How many people on the radio have been telling you the stock market's going to crash for how many years now? They've been wrong, right? All I said was, when it gets to a certain price, it has to either correct or the income from the companies has to go up to meet that valuation. In the short term, it doesn't have to do anything. In the long term, it has never failed to correct one way or the other. Either the earnings skyrocket or the price has to fall.
Victor, I remember you and I sitting here talking, a year and a half ago, about the brokerage accounts being out on margin so much. And when so much money is on margin, it's one of the writing on the wall, red flag. It's another one of the many signals that we've gotten that we shouldn't be where we are. So what does that show you? All these things that we know, all this knowledge, moving averages, too much money on margin, they're warning signs, but nothing is finite. Nothing's concrete. Just
I've been doing a little private taking note of things lately. And I'm trying to think of every time something negative I know would be negative to the economy and see what it does to the market. Like, how about a North Korean missile test?
Intercontinental ballistic
right.
that can reach anywhere in the United States.
Is there anybody out there crazy enough to think that helps the economy? If we get in a war with North Korea and China, do you think there's any way? It's not, right? Well, the last 3 missile tests made new highs every single time. If you think of anything, now don't get me wrong, there are good things out there. We've got really low unemployment. There's a lot of things that are good out there. It's just not good for this much.
Yep.
Every single bit of bad news we've had, it made a new high. When it does that, that is so familiar to 2000 or 1999 and 2006 or 7, when no matter what happened, it went up.
What were we talking about at lunch just the other day about volatility?
Mm-hmm. Volatility now it's gone down. They're thinking people, they said, have lost all fear. When you lose all fear, that's when it crashes. Don't get me wrong. A lot of people got in this market late. It's gone up almost 9 years now. A lot of people didn't jump in it for the first 4 or 5 because they remembered 2007. Now that everybody's all in, the problem is the math will never lie. You can hear economist this, radio guy this, radio guy that. The math never does. You got 30 times earning as the PE ratio, so you bought a company. It would take 30 years to get your money back. Nobody in their right mind would buy that company.
But just to take the other side of the coin, because again, we've got lots of folks in our managed program in the market. Anything could happen, because if we knew absolutely for sure, because of all of these signs, within the next 12 months, the market was going to go down 30%, there would be a way that we could make an awful lot of money and capitalize, whether it was long-term options, leaps, whatever it may be, we don't know. The market could show us something completely different and can run up for another 5 years and set crazy records. And because of that, because we don't know, because of the uncertainty, because it's not an absolute, that's why the philosophy was developed. You take care of the hard assets, and guess what? It doesn't matter. Like Victor said again a few minutes ago, you can have Bitcoin. Enjoy some of that. If it works, it wouldn't take much, $10,000. Right. You're pretty happy. And if you lose it, it's not going to change your plans for lunch and retirement. So make sure the hard assets, your costs, are taken care of in retirement. And enjoy the ride when it goes up, and you won't sweat the downturns.
And remember the rule of 100s. 100 minus your age, or just say your age. The easiest way is your age is how much you should have safe.
I'm 70 years old.
You should have 70% safe. Now, what has happened is one asset class, the equities, have outperformed all the other asset classes. And if you're in stocks that haven't outperformed CDs, you need to stop what you're doing. you got issues.
Yeah. Forget that rule.
Right.
That was
so what happened is, they've grown to such amount. If you'd have done that the whole time, every single crash that happened, you'd have got way less of it. It would have actually, you could have minimized the effect by 50 to 75% if you'd have done allocation as you go. But it's intoxicating, and honestly, it's human nature. It is very difficult. Like, I've got stocks that made 25% in the last year. You want to sell that and buy something for 1% or 2%?
Yeah, it's
3%?
hard. Counterintuitive.
Very hard to do.
But think about how this, this is a rule to you. Okay, they say if I'm 70 should be safe, 30% should be in the market. But there's a lot that went into, it was a College of Financial Planners actually out of Colorado, I believe, that came up with the rule. There's a lot that went into it. Think about it. The market's crashing in 08. And as Victor said, you're not wanting to buy, right? But if you were 70 then, 70 safe, 30% in the market, it's crashing. Your 30% opposite of what's happening today has gone down maybe to 15%. What do you got to do? You got to buy when the market's going down. But that's what you should do, right? Your dollar cost averaging is a fancy way of saying you're buying it when it's going down, when it's low. What happens now? You're 70-30. It's not 70-30. You're 30%. Your market percent probably is 50% right now. And again, it's painful, just like buying a stock on the way down. Now you've got to sell one that's going up. This is a nutty system, right? But it's there for a reason. So now you sell off back down to 30. So when it does crash, you were able to take some of that off, put it back into your conservative pile to keep that at 70. Yeah.
When the market crashes, you still only lost 15% of your money, right, minus what you gained on the fixed income side.
And you're buying when it crashes to get it back up to 30.
That's what I always say. Keep your powder dry.
That's right.
Because when the market corrects, you should have some cash. Cash is king. Remember when the real estate, you could buy rental properties for nothing if you just kept your powder dry and waited for those times, not loading up as the thing is peaking. But it is what it is. But just remember, I could show you Nobel Prize winners, professors. These are people that tell you need that income stream. This is just the opposite of the people selling stocks. Now, we sell stocks too, but I'm saying like Ken Fisher and things like that to say you should annuities are the devil's work. You should never have. It's the only thing in the world that guarantees you something for life. It pays more income per dollar than other stuff. You just got to make sure you do the low-cost type, because what they'll do is say the high-cost type, everything has a benefit. Everybody tells you they're not. They're trying to sell you something else. Everything has a benefit. I don't think paying a lot for it is worth it. Like in variable annuities, you might pay 5% a year on some of these. Well, I'll tell you what, 5% a year is not worth whatever the hell they're selling.
You can't get out of your own way.
It's just not. Remember, the market only made 4 for 17 years. I'm going to pay 5 for fees? No. 1% or less? Now I'll look at it. And so that's what you have to do. But remember, we can devise a plan for you. We'll do a retirement analysis for you. Okay? We'll put in all these things. We'll put in your stock allocations. We'll put in a stress test. We'll put in a return if you want, right? But we'll also put in, what if you take this piece and do it to a guaranteed income stream? What does that do to your overall portfolio when you factor in taxes, inflation, and everything else? And we factor in things like I got somebody retiring at 55, so they're going to need 10 years worth of Obamacare.
And
which
it's
is not fun.
And it's real hard to do it at 55. We've done a lot of stress tests, and you have to have a lot of money or very low needs.
That's right. So you have to plan all those things, and we do all that for you. And then you can plug in different investments. Let's say your Uncle Irv said this is the greatest thing in the world. Well, let's plug it in there and see what it does to you long term. Yeah. Instead of somebody just giving you a sales pitch and hyping you up, sign here and you're done. Well, let's actually see what everything you can put in there does long term. And we do that at no cost or obligation. Call us at 972-715-2424. Again, 972-715-2424, or you can go to our website, ilovemyretirement.com.
And I'll add to that, we will not use an 8% average rate of return to figure out how you'll do. We'll be way more conservative than that.
Also, there's a research analyst, is a think tank that always does all these forward projections of the market. They've been pretty accurate for a long time. And what they're saying is they're not one of these people that thinks the market's going to crash, which is in the minority right now. Most people are thinking, yeah, it's got to have a correction. They're not saying that. What they're saying is if you look at the returns, like since 1878,
right,
a 60-40 bond portfolio has yielded around 4%. Now, that's just the yield.
60 stocks, 40 bonds?
That's right. That's just the yield itself. You still get the appreciation of the stock or bonds.
How much yield?
4. And the average return was like 9 or 10,
Got
right?
it.
They believe over the next decade, because of valuations where they are, they took every time valuations were this level, every time in history, what did the next 10 years bring? And they said your total 60-40 portfolio will bring 2.6% a year for the next 10 years. This is not assuming a crash. Everybody else is kind of assuming a crash now. This is saying, no, just if normal things happen without a crash.
Just kind of a static market?
Yeah, 2.6. Now, we already told you it's been 4.06 since 2000, 17 years.
All in.
So now it's going to be 2.6. So all those rules, the 4% rule, where you take out 4% of your assets and increase it for inflation every year, that's out the door. Now they're saying maybe 2% you can take out. Now a lot of people say, what does that mean? Well, 2% takes out, you save $1 million, you could spend $20,000 a year.
I was hoping as I got closer to retirement that they'd increase it to 6 or 7%. It's going the wrong way.
And what they've also said is, if you do that, if the stock market does crash, you have to reduce your spending, which confirms what we said, our philosophy. It reinforces our philosophy. Have your bills paid for by a guaranteed income stream. You're not having to, let's say the market crashes 50% and you're relying on that 2.6% in return for the market. Now are you going to pay half the water bill? How about half the electric bill? Well, they say, no, just wait for the market and I'll start paying full amount later.
I'll make it up to you.
But that's what people do. That's what, I wish I could say the company, but they're way bigger than me, and I don't want to get sued. But they tell everybody, oh, my gosh, you're going to be fine. If you want to go to an advisor who's going to tell you what you want to hear.
Write it on a piece of paper. I'll tell them the company.
What you want to hear is you're doing great, everything's fine. As long as you stick with this stock, you're fine.
Yeah.
But maybe you do my managed program because my managed program is beating the stock market by XXX, right? But the truth is you have to know what is a bad time. What if you stress test the portfolio? Am I eating cat food when I'm 80? That's what you have to find out. Because if you are, you got to be careful. I talked to a person this week, and they said, no, I put only 4% returns in there. And I said, were you eating cat food? He goes, no, I still may. I go, how about 0? He goes, I even put 0. I go, well, then that's a pretty good test.
Yeah.
If your bills aren't going to be paid by a fluctuating stock market, there's nothing wrong with it. And remember, we've been doing stocks a lot longer than annuities or anything else. We love the stock market. We manage people's money in Fidelity. We love it, right? But I just know I don't do it until after the bills are paid. Once your bills are paid, if you got a big enough pension, Social Security, and you have low expenses, you don't need anything else. I mean, you might want to, like our managed program is designed to take you out if it goes down. I think the worst down year ever is like 7%. So that's a good option right now.
And if you're thinking, well, I don't know, I need an inflation hedge, you're absolutely right. And the stock market is a good inflation hedge. Hedge was hard to say. But keep in mind, you can get income from fixed annuities as you're taking care of your expenses that increase when the market does. So if it goes the way their interest is credited, if it goes up 4%, your payment goes up 4%, and that becomes your new floor. If it loses or stays static for the next several years, your payment stays the same. Next time, the interest crediting method gives you a 6 or 7% bump. your income goes up. So the answer to the question is there are some income strategies you can use that are kind of a hybrid of both income strategy and inflation hedge.
We got them something that went up 13% last year.
It's crazy.
That's for life. They got a payment. They were getting $4,000 a month. Now they're getting $4,000 plus 13% for the rest of their life, and it's locked in.
You know, everyone talks about fees and annuities. There really isn't any annual fees other than if you have a lifetime withdrawal benefit or something. But there's surrender charges, right? You can get 10% of your money penalty free. So there would only be a penalty on 90%. Usually it goes down each year. I had a client that after 1 year, we're just doing it now, needed to liquidate one of their accounts. Let's say it's the value of the account doesn't matter. But the penalty on that, because just poor planning and wasn't very good with their money, was 9% on 90%. 9% penalty this year. Good news, she made 9.5%. So it's not something made to handcuff you and restrict you from doing things. It's not as bad as some people will tell you.
Maintaining control of your principal is one thing. That's what you want to make sure.
Yep.
I don't do anything that becomes illiquid forever. No, you can't do that.
That's right.
And so if you have a penalty for a couple of years or something like that, that's not illiquid.
And that's as ugly as it gets. That was
right.
a first year, poor management.
It's just like buying a 5-year CD. If you want your money tomorrow, you can go get your money tomorrow, but you got to pay the penalty.
That's right.
So, but they said, what if you have a stock and bond portfolio and you'd like more than 2.6 for the next 10 years? Well, what they're recommending is a 40-50% allocation in foreign stocks, like blue chip foreigns, not a bank in Paraguay, but blue chip type stocks, like your Mercedes-Benz, your Toyota. Those are blue chip foreign stocks. And
that's the problem with foreign stocks they were talking about. They don't make much. They're the ones that are doing well are banking stocks. We're the country that makes stuff.
No, I know. That's what they're saying is that by the same metrics we're talking about, ours is overvalued, theirs is undervalued.
Right.
And they said, would you do all of that? Because they think they could make 7 or 8% over that same 10-year period. So if you did a 60-40 allocation between U.S. and international, you could make 5%. But think about all that kind of stuff. We have investments right here that are back tested. They can't lose ever. There's no fees. They made 5 to 7% over any rolling 10-year period, always. So wait a minute. So we just said that research analysts, one of the biggest think tanks out there, says 2.6% returns on U.S. stocks, maybe 6 or 7 on international stocks. We already know the risk in international stocks, right? Well, if you can get 5 to 7 without risking the money, without worrying about it, why wouldn't you think about that? And that's what we're trying to do is there are things out there right now. You can get a 5 to 7% long-term yield, but not worry about losing the money.
And you kind of get numb to it. When Victor says that they may do, what was the number, 5%?
5 to 7, yeah.
5 to 7% on these international stocks.
Yeah.
It's not going to be 5 every year or 6, 6, 6. It's 15 one year, 0 another, 4 1 year, you lose 6 the next. It's not a nice, easy, consistent growth.
See, I've always been under the impression, I've been doing this a long time. This is the 30th year. You've been doing about 32 years or so. And I'm one of those guys that I don't have to make 30% a year. I'll tell you what, if I can just make, say, 4 to 8 and not worry about the money ever, don't worry about losing money or whatever, I'm pretty happy because I've seen what compounding 5% a year over a long period of time does. And I've seen not worrying about it crashing every other day. Or, am I in too long? Do I need to reallocate? Oh, I don't. If I reallocate, in other words, you sell something that just made 25%, I can't do it. It's too hard to do. I'm not going to selling something 25% to make something making 3. Very difficult to do. Going from equities to bond. This does it automatically. It's paying 5 or 7% forever, and you don't have to worry about the money. That is one thing that I'm very interested in. Like I said, we can, call us if you want to. We'll be able to send you illustrations or whatever. 972-715-2424. Well, that's our show, folks. The music's calling me out the hook. I want to thank everybody for listening today. Remember, if you have any financial questions, you'd like to take advantage of our no-cost, no-obligation retirement plan, Social Security Optimizer, or just another way to make a decent return without risking the money, call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. I'm Victor McClure for Guy Allett. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.